for critical minerals essential to our electric future is set to triple by 2040. In the next 5 years, Europe will rely heavily on expanding existing mines and brownfield projects. However, greenfield development is crucial to fully meet demand despite its challenges.
Scaling operations, embracing M&A, navigating government roles, and securing financing are key issues. Who will fund Europe's next mining era?
Investment goes beyond capital. It requires trust and transparency. Integrated reporting that combines traditional frameworks like PERC and UNFC with innovative ESG tools like TNFD is now vital to reduce risk, build credibility, and unlock funding for early-stage exploration.
With shifting political landscapes, protecting investments is critical. Discover how mining companies can manage political risk and use international treaties to safeguard their projects. The future of financing mining in Europe begins today.
Good morning, everyone. So happy to see all of you, although it's quite early hour. Hope you have a very great evening yesterday, and it's my great pleasure to welcome you on the second day of our conference, especially here in Lisbon, which has been a city that has seen explorers set sail to map the unworld world. So today, we are going to talk about another kind of exploration, one beneath the surface. One could decide, actually, if Europe truly managed to build in green and digital, and I think today quite important, safe future. We all know the story by now. The green energy transition is metal hungry. Without copper, there is no electrification. Without lithium, no batteries. Without nickel, cobalt, rare earths, there are no turbines, no EVs, no grid storage. And yet, as Europe races to hit its climate and industrial targets, we find ourselves dangerously short of what's the raw materials we actually need. So European Commission last year, they recognized that need. They pronounced the Critical Raw Materials Act, which is a framework meant to secure supply chains, streamline permitting, and attract private capital. But still, on paper, is a great initiative, it's bold, and it's only on paper. So we are meeting today to see what are the missing puzzles, and for sure one of those missing puzzles is financing. Governments of our European countries, they talk about strategic autonomy, but the reality is that the money moves faster than the policies, and it often moves elsewhere, to Australia, to Chile, to Canada, and those money are not staying in Europe. So that's why we gather here a group of experts, of people who live at the heart of this problem and who hopefully can help us see the way forward. They came from worlds of banking, private equity, capital markets, law, and mining operations, each with a different lens of what it takes to make a project real. Together, they represent perhaps the most critical part of the mining ecosystem, the people who decide what gets financed and what doesn't. So the question I would like to pose today to our experts, but also to all of you, is very simple. How do we make mining in Europe investable again? How we do make it accessible, affordable, and sustainable, but not just in words and not just in the policies, but in practice and how we can see it on the ground. So we'll start with 3 presentations today, and I will first ask to the stage Mr. Artem Volnets, CEO of ACG Metals, to present his views on who will finance the next generation of Europe's critical mineral supply chains. Artem, please.
Thank you very much. Good morning. Clearly, I had a good night yesterday. I see the half of the audience here. I was asked to speak on this question. Have everybody read the title? It took me a while to get it through. There's not one, there's 3 questions. Who is supposed to be the next generation of the critical supply, and there are supposed to be implications as well. So the organizers of this forum kindly asked me to talk about this simple topic, and they asked me to be provocative. In Economics 101, a long time ago, my professor told me, if you don't know what to say, talk about supply and demand. The only supply and demand I know is that of copper. The story here is very simple. copper is going to the next pricing level because supply is going behind demand. Demand is growing across all sectors of the economy. And fortunate for us, the copper producers, the demand is driven by a number of different applications, not only traditional ones such as construction, grid, etc., but also the new sectors, data centers for artificial intelligence, robotics, etc. So if one of them doesn't perform as expected, there is another one to take its place. And therefore, the fluctuation in the copper price is unlikely to be as severe as, for example, in nickel when in 2023, when the EV adoption slowed up, the nickel prices went down 50%. We do not expect that to happen in copper, especially because the traditional sectors and Chinese growth are not slowing down significantly, and traditional sectors such as defense require more and more ammunition to be produced. And what is ammunition? It is copper. Certainly, the picture, if you look in Europe, look even worse. Europe is not DRC, it is not Kazakhstan, it is not Chile. We do not have many copper mines in the continent, other than in the Iberian Peninsula, some in Eastern Europe. But copper market is global. Yet we've been threatened with this scary picture of a new confrontation between East and West and polarizing supply chain. I remember that. When I was growing up in the Soviet Union, this is the images that symbolizes polarization of East and West, and feels like we are going back into the same territory. So what do you do when these things happened? Well, you go to the places which traditionally been on the crossroads between East and West. In this particular case, Turkey, been between East and West by definition for thousands of years. ACG Metals acquired a producing mine in Turkey a year and 1 month ago. We're currently producing gold, transitioning to copper. Turkey also benefits from the low costs versus Europe, so we are producing gold at about $1,100 per ounce. Even after yesterday's fluctuation in the gold price, that still means $3,000 per ounce in EBITDA margin. That's not bad. And when we transition into copper, we'll be producing copper at below $2 per pound. This year alone, the Turkish lira depreciated by 16%. Our cost is about 65 in the local currency, 65%. So our cost position continues to improve, which means we are generating $75 million free cash flow this year. Once we convert into the copper production by middle of next year, our free cash flow at consensus pricing should be around $100 million. So at least one of the questions posed to me by the organizers, which is who are the next generation of the critical metals producers, that certainly seems to me like a good example of the next generation. It's a new company, it's even younger than Generation Z. We are only starting to produce copper from next year, so as new as it gets. And you can see all these little square boxes in Europe. This is all the copper smelters, which certainly underutilized and overcapacity. And here we are, just across the pond, just across the Mediterranean Sea, 3 hours drive to Izmir port on the Mediterranean coast of Turkey, within easy reach to many of the smelters. So we will supply copper to Europe. How we finance that? Well, a typical question you get is, you have a private markets and you have governments to finance, quote unquote, the next generation. Certainly in this part of the world, people ask questions. We can do that if London Metal Exchange maintains its presence. Sounds logical, right? Why LME would lose its competitive advantage? Well, why a country of 60 million people would leave a single market and hamper its economic growth? Why would the government of a certain country push all the wealthy individuals to leave its capital, London? So those kind of irrational decisions perhaps do not contribute to the good financing environment. But for me, as an entrepreneur in this sector, I have plenty of other options to finance our business. As you can see, the money raised for mining in Hong Kong many times over what it is in other parts of the world. I have listed a company in Hong Kong before. You can raise money there. If I'm not going to get any funding in Europe, I'll go to other places. Certainly people and bureaucrats in this part of the world have many reasons to say why Europe perhaps is less competitive than other parts of the world in funding of critical metals projects. But the reality is very simple. A good project finances itself. Capital is global, and I can give you a good example. Even in divided Europe, there are pockets of private capital which can be very efficient. We acquired our asset in Turkey in September of last year. 3 months later, we raised $200 million in Nordic bonds to finance transition in this mine from production of gold into production of copper. Yes, you can say it's expensive capital, 14.75%, but the whole process took 5 weeks from the start to money in the bank. I was stupid to do it 2 days before Christmas. That's perhaps another reason for the high coupon. But the bonds have since traded down. You can see that our yield to maturity now is 11.5%. That's our true cost of capital. Other ways for me to finance this project would have been from a private equity. Some of the names I mentioned here yesterday of the big private equity groups, I did have an offer from one of them for 20% cost of capital. That's more expensive. I could have gone to the banks, but that process would take 6 to 9 months. And given the fact that the project upon completion will generate $100 million in free cash flow, I would have lost at least 2 quarters, so $50 million. That would have been more expensive. So my next bond will be priced at around 11%, not 14.5%, and we have a good track record now with capital markets, not only on the equity side, as I show in a few minutes, but also on the debt side. So that market is open finance to finance the next acquisition on the next project. People talk a lot about the government and how the government should allocate a lot of money into mining sector, and the White House certainly does, with somewhat successful returns on investment. I would argue that in our particular case, we are beating the White House portfolio a little bit. The question is what's going to happen with all these White House investments when administration changes. In our sector, when you build a mining project, that's for the duration of 4 to 5 administrations. You cannot rely on any particular one of them to give you capital that will last through these 4 or 5 political cycles. So who will finance the next generation of blah, blah, blah projects? Well, happy investors. Every single investor in my company has made money from the start. Those who stayed with us before, you can start from early on. I originally launched ACG as a SPAC. They made 5 times their money in 2.5 years. That's pretty good. Those who stayed with us for a short period of time, such as IPO investors, made a little bit less money, but everybody is in a green. So answering the question posed to me by the organizers of this forum, who will finance the next generation of critical metals projects? Well, in our particular case, the next generation of critical metals projects is financed by the private investors who are happy with returns, and they're chasing me to allocate more capital to what we'll do. So what are the implications? The good deal finances itself. Thank you.
Thank you, Artem. And Artem will also join us later during the panel discussions. So I think as we have representatives of different types of financing structure, that will be an interesting discussion. Now, I would like to welcome Mr. Louis Chambel, Managing Partner of Iberian Mining Engineers Board, to present the topic on the risk reduction and investment enhancement through integrated reporting. Louis.
Good morning. It's early to talk about standards, rules, but that is part of what I'll be addressing today. So I work mostly in exploration projects, mostly around the Atlantic, both in Brazil and in Angola. Sorry. It's fine. A little bit in the Iberian Peninsula in Portugal. I've been involved in, or I am involved with many companies and projects. And this is about the experience we've got in those projects. Of course, it's my personal opinion, not of the companies that I work with. Now, the focus, this is MINEX Europe. It's Europe. It's a complicated setting. We are currently being challenged both in economy, politics, also in our societies. And this happens, as the previous speaker mentioned, in a risk-averse continent, a risk-averse society. So we lost, in wider Europe, we lost our preeminence in the mining and exploration industries. Plenty of examples. And last week, we've got these emails from MINEX, and with not the most rosy news. UK lost the Pensana refinery to the US. So this is not the East-West fight or competition. The European Union seeks to counter China's expanded rare earth controls, and there are threats into the European auto industry. And these are just a couple of last Friday's news. Now, the European Union last year issued the Critical Raw Materials Act, which aimed to increase the mining and processing activity in Europe. It does so, it sets targets, namely of streamlined licensing processes. Let's see what happens. I'm not seeing that happening here in Portugal. I don't know in other countries. Now, I found this curious because Europe has a standard for resource and reserves reporting, what I call the 3 Rs, but is pushing for UNFC, another standard. Now, it seems that it could be one or the other, one versus the other. UNFC has been developed with its roots in Crisco, by the United Nations. And as all bureaucracies, it tends to create applications to a tool. It's an interesting concept, not unfamiliar to what we use in market-driven standards. And we also have PERC, the Pan-European Resources Reporting, which has a long history. It started by being a standard adopted by a couple yet important jurisdictions, and now it aims or is pan-European. Now, it's not a question of one or the other. Both can be used. One is more market-driven, which is PERC. The other is for national government agencies planning. And it's easy to bridge between two. There is a document that bridges between the two standards and actually between UNFC and CRISCO standards that was issued last year. Now, reporting, it's really complicated. I feel it every day. I work mostly in exploration. And actually, this is exploration in Angola. That is the Chicapa River. We are both flying our drones, exploring for diamonds, which is not the commodity, a fashionable commodity nowadays. So it's really hard work. But at the same time as we are exploring for kimberlites and diamonds, we are exploring for biodiversity. The same people, it's just another tool in our belt, and we have been doing that. Now the problem is how to report it, because we have standards for resource and reserves reporting, and we are using actually PERC as our company. The company that we are working for in this case is headquartered in Luxembourg, but we are also preparing a report for Canadian securities, which is the NI 43-101, which is being reviewed currently. At the same time, we want to report biodiversity, ESG, and we've got to this Babel Tower situation. Now, this is something just for resource and reserves situation. This is 5-6 years ago. It has changed. It got complicated because we have got CRISCO and UNFC, and then we have the national standards, and these have guidelines, best practices. Well, what you see there. It's really became complicated. Now, CRISCO is in the root of everything. It's CRISCO that created international templates from which all these national standards were created. And I believe we have to go back to CRISCO to try to unify the standards. Now, we also have similar entities for environmental and social reporting. But it's also complicated over there because we have standards for climate reporting, climate impact reporting, and we have standards for biodiversity reporting. And they don't still create a single report. We are also working with the NFD, which is for biodiversity. It's a sweet spot of mine. We have to change from the Babel Tower into a Rosetta Stone. We have to evolve to make it easier for companies to report their assets, their reserves, their resources, but also the impacts they generate. Investors and other stakeholders want to have the full view in something which is not 10 different reports. Now, some of the things that are close to my heart is that usual reports have a competent person. It isn't enough. Typically a geologist or a mining engineer. He reports on resources, reserves, on the value of the projects, and often they use the magical 8% discount rate. Because, well, everyone does like that, why wouldn't you do it like that? We need, rather than a single person, a set of skills by a team. UNFC does that, but they also have their faults. We have to be global, yes, in the reports, usually in English, but that's where we miss local people. I'm working with the Angolan government to try to have reports, yes, for the global investment, but also that involve the local populations. And of course, if we could converge, that would be very, very useful, because it would allow a transparent, full perspective of our projects into investors and stakeholders. Thank you for your patience. Thank you for IMAB, the Iberian Mining Engineers Board, that pushed me to do this presentation. Thank you to the companies that support our work. Thank you.
Thank you, Louis. I think that integrated reporting is all what we are looking at, because we have to create all those reports after reports. It will be fantastic to see how to actually integrate all of those standards. So I will ask now Mr. Gentleman Markus Burgstaller, partner at Hogan Lowe's, to talk a little bit about the protection of foreign investments, and especially in the context of the disputes actually that we have in Europe. Yes, yesterday and today in the corridors we've heard a lot about different mining projects in Europe, some of them in Balkans. So I think this is a very interesting topic for all of those in this space. Markus, please.
Thank you very much, Alexandra. Many of you will have attended mining conferences in recent years where a significant portion of the agenda is dedicated to geopolitics. This invariably involves discussion of tariffs, trade wars, influence shifting, and resource nationalism. Political risk is a major factor influencing boardroom decisions on whether to invest, and it has a real effect on those investments. As the competition for critical metals and minerals intensifies, what is in the ground does not necessarily align with international borders. To meet forecasted demand, mining companies are increasingly having to look beyond Tier 1 jurisdictions and source minerals and materials from states that have a higher degree of political risk. Certain governments in resource-rich states want to ensure that more of their natural resources are allocated to the state rather than to foreign investors. States are increasingly changing mining regulations and laws concerning taxation, local content, revenue distribution, and environmental stewardship. All of these issues can directly impact the risk profile and economic viability of projects. So how then can an investment in mining in a foreign state be protected from these risks? Mining companies are leaders in building effective relationships with the government in the states in which they operate. Good partnerships are essential to doing good business. However, relationships can falter. For example, during an election cycle, a strong relationship with a foreign investor may be a distant second to populist policy. While mining companies should of course continue to prioritize and foster these relationships and diplomatic solutions to disputes, it is essential, where possible, that they prepare for the worst-case scenario. This can be done by ensuring that their investments are protected under investment treaties. In the remainder of my remarks, I'm going to discuss what investment treaties are, how investors obtain protection, and then I will provide some practical insights on how investment treaties operate when something goes wrong. So let's start with the basics. What are investment treaties? An investment treaty is a treaty concluded between two or more states. It is designed to encourage foreign investments by offering protection to foreign investments from one state in another state. The overarching idea is simple. If the home state of the investor has an investment treaty with the host state of the investment, that is your project, you may be entitled to protection if the host state of your investment adopts internationally wrongful conduct which adversely affects your investment. Under an investment treaty, states agree to adopt certain obligations. For example, they agree typically to treat investments in a fair and equitable manner, not to expropriate investments unlawfully without compensation, or to treat foreign investors like they treat domestic investors. And states may be in breach of these international legal obligations if, for example, they revoke a mining license or they impose retroactive taxes. A state may also be in breach of its international legal obligations if it delays for years permits without giving any explanation, or if it shuts a project based on unclear environmental concerns. The key benefit is that investment treaties commonly give direct access to international arbitration without further consent from the host state. Thus, if the state takes steps contrary to its obligations under an investment treaty, a claim can be heard by an international tribunal. And that is obviously significantly better a position you're in than you have to go to the local courts of the host state of the investment. Because there you face the investor on its home turf. Contrary, an international tribunal will apply international law, and if a claim is successful, award damages to the investor, such that the investor is put in the position it would have been in, but for the wrongful conduct by the state. And these damages can be significant. If the state does not comply with an award, it can be enforced in virtually all states. It is also important to consider structuring your investment at the outset. Structuring an investment to benefit from the protections of an investment treaty is not a signal of mistrust or a sign of warfare. Crucially, an investment treaty is not an agreement that you have to conclude as a mining company with the host state. There is no contract that needs to be entered into because it is a treaty concluded between two states. So what investors need to ensure is that they have a company in their structure of their investment that is incorporated in a state which has an investment treaty in force with the host state of the investment. That could be the ultimate parent company, or it could be an intermediate company. It doesn't have to be the locally incorporated company that can bring the claim. It can be any company in the investment structure. And indirectly held investments would typically be protected. Investment treaties, if you ever had a chance to look at one of those, may appear homogeneous, but they really are not. They have crucial differences when it comes to who is protected, the extent of the protection, and what can be put in a dispute before an international tribunal. So when structuring an investment, it's important to have an experienced lawyer assess whether protection is available or not. Provided that a dispute is not already foreseeable, you can also seek to restructure your investment such that you put a protection way in place that allows you to bring a claim in case a dispute arises. Of course, this cannot be done in isolation, and it will frequently also involve corporate and tax considerations. Regrettably, however, for mining investors, sometimes bringing a claim will be the only option. An ever-increasing proportion of investment claims are being brought in the mining sector. This happens because sometimes states conduct means that an investment is no longer viable, and bringing a claim is the only way to recover some value of investments. Many of these cases arise in the exploration or development stage when significant money has gone in with the prospect of cash flow in the distant future. Now, I've been involved in a number of such disputes in the mining sector, in particular in Europe and in Asia. For example, I'm currently involved in a dispute involving a gold mine in India. When leading such cases, it is important to get the strategy right at the outset, and we always work together with experts in the field, not only industry experts, but also damages experts, to value these investments. These experts will then also testify before an international tribunal. In many of these cases, there are also third-party funders involved. These are funders who not only would pay for the lawyer's fees, but also for the expert's fees. These funders would then invest in the case before the tribunal on a non-recourse basis, which means that if the case is not successful, their money will have been invested in vain. If the case, however, is successful, they will demand a proportion or a multiple of their investment. Most mining investors, at the very least, look at whether funding would be available in order to make sure that they have the legal and expert cost of the balance sheets. So to summarize, investment treaties are a vital tool for protecting mining investments in foreign jurisdictions. They offer enforceable rights if a state adopts internationally wrongful conduct. And you need to plan ahead and structure your investments properly so that you are entitled to protection under investment treaty when something goes wrong. If you're investing in a new country, or if you're becoming increasingly concerned about political risk in the country where you're invested, take legal advice. Thank you very much.
Thank you, Marcus. I think some of us will definitely listen. Let's start now with the panel discussions. I'm very happy to welcome on stage experts in the financing space. The first gentleman, Stefan Puschel, Head of Metals and Mining at KfW IPEX Bank. Stefan, please come, welcome. Benedikt Sobotka, Principal at Alpha Future Funds. Stefan Müller from DWA from Germany. Axel Kalinowski, Head of Central and Southeast Europe and London Stock Exchange. Axel, yeah. Michael Zlobin, Equity Portfolio Manager at European Bank for Reconstruction and Development. And back to the stage, Artem Volnis from ACG Metals Limited.
Okay, we're working. Thank you, gentlemen. I'm very happy that all you made it here. And after listening to the presentation and what Artem thinks about the possibilities of financing of his projects and other projects in Europe, I'll be very happy to hear from you how do you see your institutions making a contribution into this quite urgent topic. So Stefan, let me start with you. You represent one of the few commercial banks in Europe that still actively finance mining, metals, and processing facilities. KfW IPEX often takes a long-term industrial view rather than the short-term, while the most commercial lenders have moved away from this type of financing. So why do you think is that? And why do you think only few commercial banks today in Europe are still willing to take this mining risk? And what would have to change? Is it regulation? Is it disclosure? Is it governmental support for more banks to return to mining and to start financing all those lovely projects we label as a critical last year?
Thank you. Yeah, fair point. Yeah, indeed, if you look at the world of project finance, yeah, mining banks are definitely underrepresented. Yeah, it's a small niche, and there are good reasons for that. One is the risk profile of the financings you're doing. Yeah, I mean, as a matter of fact, mining is more risky. Yeah, you need a very specialized skill set you have to really invest in. Yeah, and not only on the financing side, you will also need experts in geology. You will need experts on the technical side. You will need experts on the environmental side. Yeah, so it's really an investment for a bank to cater for these teams, and you have also to be aware of that you don't have many economies of scale. Yeah, it's not that you have as many mining projects every year as you might have, for example, in wind, onshore wind financings, infrastructure financings. We have also much more structures which you can benchmark. So this is definitely one point you have. Secondly, it's ESG. It was mentioned several times also yesterday. By definition, mining has an impact on its environment. Yeah, it's naturally. Yeah, and you have really to make sure that you have a very thorough due diligence on the environmental side, on the social side, stakeholder management. And you have to be aware of, even as a bank, you're really an attractive target also for critical voices, yeah, who are not always very positive when it comes to mining. So the second point. So and third point is you need a very long breath when it comes to mining. Some of you might have listened to one of the presentations. On average, from advanced exploration to a producing mine, it takes roughly 15 years. Yeah. So this really, it's very time consuming. So taking all these 3 points together is probably the main reasons why not so many commercial banks are focused on mining. So coming to a question, what can be done? Yeah, I mean, I would say if it's on the timeline, I mean, some limited leeway might be in permitting, like the CRMA tries to achieve, yeah, that permitting gets quicker. In ESG, I would say, yes, you cannot reduce the scrutiny. I mean, you have to really take this serious. It might be that there might be less administrative burden, but at the core, the due diligence, I wouldn't advise to really go below these standards. So what is left? What is left is the risk profile of the financing. And here, there is some leverage. And on the one hand, you have established instruments, ECA-covered, untied loans, the government also take over some risk. However, there's also one area which you could really get tremendous support, and this would be floor price support. Really de-risk the project on the pricing side, because especially in battery minerals, we face emerging markets. It's really difficult to provide price forecasts. Yeah, there is a lot of influence on the pricing. It's very difficult to understand these markets. And if you could de-risk projects on that side, I'm sure you will attract more liquidity.
Which might help the automotive sector in Germany, especially.
For example.
Yes, so staying in Germany, Stefan, maybe to you. The GWA works daily with junior and mid-tier mining and processing companies trying to raise money in Europe, and you see firsthand how slow and sometimes fragmented these options for them are, yes? So what do you think is the missing puzzle in Europe? Is it like a political vision at the EU level? Is it the support of the national governments or the commitment to co-finance or become the active equity partner? Or what would be your recommendations based on your experience for those junior miners who are now trying to bring back mining to Europe?
Well, good morning here, everybody in Lisbon. It's a mix of all, of course. And I have to be in Berlin very often the last couple of weeks, not that I want to, but I have to. And I'm not here to give a diplomatic speech. It have been some of the most disappointing meetings I've ever had in my 35-year-long career. They simply don't understand it. They simply don't understand it. Politicians like to talk, then after they talk again, and they meet and they talk and they meet and they talk, and they don't like decisions. They like to find a way, and then they see it's right or wrong. Like in foreign policy, you can discuss for ages how to behave, how to deal with China, Russia, the US, whatever, and then you start, it's a try and error, and then you do the next thing. But in mining, our business, it's dictated by hard facts. You hardly find other businesses that are so dictated by hard facts. Everybody knows, or you can somehow calculate the amount in each and every mineral that comes to the market in the next 10 years by, let's say, 10%. You can also calculate the demand in the industry, maybe 25% up and down in the next 10 years, but whatever scenario you mean in the middle, there's always such a gap, and we all know that. And the only way to shorten that gap for us is putting money in our hands, investing. That's the only way. There is no other solution. Talking doesn't find new resources, doesn't close offtake agreements or something like that. You need to invest money. And that's something that the Europeans don't want to do, especially in Germany. The main industries that are suffering from that crisis, the automotive industry, the machinery industry, they're anyways in a big crisis. And on top of that, they should invest now. That's really hard for them. But the politicians simply don't understand it. They don't want to understand it. But it should be very easy because of everywhere in the world, we see how it goes. The Japanese, they have JOGMEC since decades. It's one of the, we don't have commercialized offices in Europe. The politicians are completely separate from the industry. Take the Critical Raw Materials Act. It's a dead-end road. In fact, it is not attached to an investment. It would make sense if they say, okay, we select these companies, and then we have an investment scheme behind that. Whatever, 20 million cash in the beginning, and then whatever the companies want to achieve, step-by-step thing. What happens, in fact, is, let's take one company as an example, but there's others. Take a company, Tungsten West. Right? They are in the UK, it's not the European Union, but they're in Europe. They produce tungsten, one of the most critical defense minerals. They are selected as a critical raw materials project in Europe. The stock price went up 300%. Guess who are the two most interested parties in investing there? It's the Japanese and it's the Americans. It's not the Europeans. No Rheinmetall, nobody. Nobody goes there. The same with antimony projects, with all these projects we have in Europe. We make the work, and then the others come and harvest the end product. I have no idea why it is, but these speeches we held since 2 or 3 years. I say every week on every conference, I say the same thing. And in Berlin and Brussels, we say the same things. Nothing is changing. In the last 2 years, correct me if I'm wrong, there is no single lighthouse project in Europe where the industry, some banks, and other investors have created a real interesting deal. While we just saw in your presentation, the portfolio of the White Horse in the last, 2 months, they invested billions and billions and billions into the business. Not only that they make money with it, they get access to these critical raw materials. The next thing is that the industries, or that the governments, in Germany, for example, with the German government fund, it's managed by KfW, but the investment decision at the end is done by politicians. And it's a political decision, which is not correct, because of mining investments are absolutely pure fact-driven. And it's very easy. Is it enough product? Is it cheap enough to produce? And is there environmental issues? If these 3 problems are solved, you can do it. And there is, in this room, everywhere in the world, since decades, there is hundreds and thousands of people who make a lot of money with investments along the whole value chain. And a government should only invest when it's really dangerous, like the airlines in Corona or something like that. You don't find an investor who gives Lufthansa overnight 10 billion euros. But the Americans set up a €5 billion or dollar mining and minerals fund, and they give the money to a specialist. That's what you should do. This is what specialists are good for, and this room is full of specialists. We are all specialists. So the German government has that Rohstoff, for example. Since 2 years, no single cent invested. One government change, nothing is happening. Instead of giving us the money, for example, we do that every day. Or you will have some ideas, I guess, how to invest that money. That's the problem. The politicians have no idea about the business, and especially in Europe, they are so far behind that we simply have no chance to get traction and come along the levels of the Americans and the Chinese. The next problem is that the projects are gone in the future. I had a discussion with the German Ministry for Economy about a exploration fund kind of stuff. And they said, yeah, we can talk about it, but the next available budget is in 2027. Which means even if they would agree to that, the money would be invested maybe 2028. And if this is the case, no single car will be produced in Germany any longer. I think that's the biggest problem. And we saw that with the Ukrainian war, unfortunately. Here in Europe, we always need these black swan events. Otherwise, the people do not understand it. They are not able to plan in advance. They see the problems, but they go around them and they think they find a solution. But that's not the case because of everybody else and the big ones, the Chinese, the US, even the Russians. The Russians get all the product from China now. They're all faster than us. As I said, it will need such a big bang. That's the only solution. I'm very pessimistic.
Okay, I hope we all not going to be that pessimist. I know that Europe is always called as the slowest agent in the global market. But Benedict, what do you think? So what kind of ecosystem we should build in Europe to make those projects bankable again and actually to slightly push our politicians, European Commission, not only European Commission, not just to talk about the projects, not just to label them, but actually start financing those projects also at the early stage, also at the exploration stage, because without exploration, we'll never get to the development.
Yeah, thank you, Alexander. What I like about this panel here on the right-hand side, we've got a lot of people talking in Europe, but not so many people doing. And this group here are actually the ones that are doing something, right? Against all the odds, against all the complications. And it's far too early for me, and I just came from the US, so I'm really jet-lagged. It's far too early for me to talk about problems. Well, let's talk a bit about solutions. Let's talk a bit about what we need to do. Maybe that can lift the spirits a little bit. And the challenge really isn't that there isn't enough money or that there aren't enough projects in Europe or that there aren't smart people. We have all that, right? So how do we bring it together? And I've spent quite a bit of time on the advisory board for CATL, which is one of the big battery makers. And they're also one of the largest producers of battery raw materials. They're probably the largest battery materials smelter company. They're integrated. I like to call them the Standard Oil of the energy transition. And we can learn a lot from that because they've been incredibly successful in building an ecosystem. And that ecosystem means there's investments not just in the early stage exploration projects, there's investments into technology companies, there's investment into midstream before they actually start to think about the downstream part, right? Because they know that's an enabling factor. And we like to focus, and particularly in Europe, always on these critical raw materials, which are elements on the periodic table, which in my point of view is total nonsense, right? And you can't have 40 critical raw materials because then everything is critical, and so nothing is critical. So if you think about it, you need to solve not a rare earth metals problem, or you need not to solve a lithium problem, you need to solve a battery problem. You need to solve a magnet problem. You need to solve a catalyst problem. So you have to take a much bigger perspective. And in Europe, I think the opportunity is that we have all these little pockets of activity, all these pockets of experts, all these pockets of great investment opportunities. You have to bring them together. And this is what we did in the last, actually, since we started Alpha Future Funds, and we've committed this year alone over 100 million in investments in the sector. We invest in early stage projects, exploration projects, because we like them, and I personally think there's great opportunities. This market is super undercapitalized, and there's great opportunities, particularly in some of these established mining jurisdictions, Scandinavia, and so on. And you have to look at this like a venture capital investment, right? 80% of your projects are going to go down the drain, right? So 10% are great, 20% are going to make all your money. But you have to be in those early, so once these projects mature, you can double down on your investment. That's something that governments are very bad at, right? They can do one investment and then they will sit on it. But for them to do a follow-on investment, how do you calculate the valuation? How do you dilute, not to dilute, and so on? It gets really complicated for government institutions. That's where the private sector needs to do this. But we've also invested significant amount into that supply chain. So drilling companies, exploration tech companies, geophysical companies, data and sensor interpretation, geophysical, geochemical drilling. We own shares in something like 20 tech companies, both in Europe, Australia, and Canada. And we want them to actually deploy their tech onto projects in Europe, because the challenge in Europe is the geology might be great, but unlocking it with all the other competing land use is very challenging, right? So what people may call green mining is effectively not something about green, it's about balancing the competing land use requirements in jurisdictions that have farming, that have industry, that have, right? People want to have, want to use it for holidaying, and it's the same location, right? And you start moving trucks in that area, people get really offended when it goes by their holiday home. Portugal is a very good example of that. We looked at a project here which probably got killed because people had their holiday homes not far from it, and not that it was dangerous, it was just, right, the perception. And that's the third point, which is remaining around perception, is we need to have people like this panel here to say, okay, what do we do, right? How do we mobilize? And that's, of course, money, but take a broader view, right? Invest across the supply chain, not just into specific projects. I think the opportunity is much bigger than that. And kudos to everyone here on this group. I think you're the trailblazers, so we need more of that. Thank you.
So integrity, supply chain approach and integration of all the technologies and R&D into the project already from the beginning. So it's not left alone when it comes to development, yeah? Okay, great. Mikael, EBRD plays a quite specific role, yes? It's often kind of a catalytic role in natural resource financing. You invest where private capital is still hesitant, but where is the strategic need and potential is high, yes? And many of your projects and the regions that you are covering is exactly where Europe hopes to secure those critical minerals. So giving your experience in bridging commercial financing and those development goals, what does it really take to bring a mining project to life? And additionally, you often act as a first equity investor in the project. So how do you see your role or the role of EBRD and in kind of a crowd-in commercial investors to follow up your path and to join the projects?
Yeah. Thank you, Alexandra. So I would probably start from making the point that EBRD is not blessed with some of the nicest mining jurisdictions. So we work in the Central, Eastern Europe, Central Asia, and Africa from recently. So we don't have the luxury of Latin America, or Canada, or Australia. So we need to really look carefully at the projects and make them work. So we are not capital constrained because we have a huge balance sheet. And unlike some other mining investors, we can invest in every financeable projects. It could be equity, it could be mezzanine, it could be debt. The problem is how, as you pointed, how to make sure these projects are fundable. Probably, I will reflect on what I've presented here at the same conference last year. We launched the JUMP Junior Miners program roughly a year ago. And unfortunately, we have not made any investment. And when we looked internally at what are the reasons, we identified that, we looked at more than 60 projects, various stages. Most of them are even pre-resource. So this is what we see in our region. So you have a lot of interest, but these are still super early stage projects. Sometimes, they're building on the Soviet drilling. Sometimes there is no resource at all. And for us, it's too early and we cannot be the angel investor, right, in this space. Someone needs to take the risk. It could be the angels, it could be the state to bring the exploration consistently and professionally to Europe and these countries, at least where we operate. So investors like us and others can take the professional junior project and finance it going forward. And then I would probably also distinguish between the base conventional metals and minerals and these battery minerals. For conventional minerals and for conventional projects, I would really agree with Artyom, who said every good project can be financed just, as easy as, maybe venture in the US. But we don't see many of those. And I think, Europe has exhausted its historical endowment in terms of these projects. But these battery projects, they require, and to Stefan's point, they require a lot of support from offtake, because I think the floor mechanism, it's a nice thing to have, but it's not sufficient, because you can have floor, but if you have 4 or 5 years to qualify what you produce, it could be lithium hydroxide, or it could be high purity manganese, still with the floor, you will not have any offtake, and then the project is not financeable. It's not financeable on the debt side, but also on the equity side, because as an equity investor, we look how we can fund the project, and there is no answer to that. This is a real problem. So I would not say the Europe or us as a BRD, we don't have appetite, risk appetite of funding to invest. We don't have sufficient pipeline and other means of support. I mean, in terms of political will or any other things. But in terms of us being an early investor and catalyst to other, I think this is true, especially in the more difficult areas. So why we believe we can provide some confidence to other people, because we execute a thorough due diligence in what we do. So it's QIC, which is like for us as a quasi-government institution is very important, then ESG, and then we have internally a geologist, a mining engineer, we have an army of sustainability people, and every project we invest in, we set up the governance and the governance around the corporate governance, the ESG governance, and some other important elements that could definitely, benefit the project, but also investors, so they can spend maybe less time and resources assessing the project if they see BRD has already invested in the project. So, but really, I can only say, let's try to find more of these projects together and cooperate and finally make those investments. Because, again, looking back 12 months, as I mentioned, we have not invested, we have not deployed the new money in our region, but what we've seen is, the junior miners, we invested 3, 4, 5 years, they finally got into production. We saw a gold mine went into production in Mongolia. We saw Adriatic, where we were early investor. It got first ore and it was bought out. It's a very successful deal, and some others. So we do have these mines in our region, but this is just a handful of those, and we definitely need to have more. Thank you.
Great, thank you. Maybe let's go to the stock exchange. Axel, pleasure to have you here. And we know that London Stock Exchange has traditionally been the global home, especially for natural resource listings and for European projects. And in the past, many of the world's leading mining companies have raised money exactly in London. But in the recent years, London IPO market has faced strong competition, and the media has been quite vocal about the challenges that London is facing right now. So can you share some of the more concrete examples on how London Stock Exchange is working to attract the new IPOs, and in particular in the energy and defense and critical mineral space, and what are the most essential reforms or strategic changes that you are planning to implement at London Stock Exchange, not to lose this competition towards North America or Australia?
All right, thank you. I could speak for hours about this question, but first of all, what are the examples of success? Well, I'm sitting here right next to an example of success, because just a little bit more than a year ago, we were at the London Stock Exchange celebrating a very special moment of Artem bringing his company to the market. And really, it's a symbol of success in terms of the way the deal was structured, having a big equity component, having a big debt component. And so it's, for me, a beautiful moment to sit here and sort of see what has happened over the last year and how well the company has done. And how you've seen in the presentation how the share price has also responded. And I think it's fair to say that I think the best is still to come. So just to say, I think it's important to also highlight success stories like this, because it shows what is possible if you have the experience, if you can build the kind of relationships, and if the story and the underlying investment makes sense. Coming to ourselves as the London Stock Exchange, many of you will know, but we have a very long-standing tradition in the mining space. In fact, our longest-standing clients are from the mining sector. So Rio Tinto, for instance, has been listed for over 150 years on the London Stock Exchange. Antofagasta has been listed for over 140 years on the London Stock Exchange. So those are big mining companies. And also on a, if you take it on a combined market capitalization perspective, London is the #1 sort of market globally with around $600 billion worth of mining companies currently trading in London every day from Monday to Friday. So from that point of view, I think there are great pieces in place, but obviously it's not easy to attract investors because the mining space is a very cyclical space. There's a lot of movement. It's a very specialized space. What are we trying to do at the London Stock Exchange? Well, we've used the last few years to basically completely revamp our entire sort of capital markets regulation and all the various pieces that need to come together. That has only really been possible once the UK sort of left the European Union, because beforehand, and that's to Stefan's earlier point, it would have been extremely difficult to get any innovation past regulators, because the rate of implementation and progress is very, very slow. So if you have to go to Brussels to ask for something to happen, and then you have to ask the French and everyone else in Europe, for permission to actually make it happen, it makes the whole process very difficult. So the good thing is that the good thing from a capital markets perspective is that, now the UK is in the driving seat and a lot has been happening. So we have been undergoing the biggest capital markets reform of the last 30 plus years, exactly with a view to, make life easier for companies to access capital markets and for investors to have the confidence to put money to work. And we are starting to see now the effects of this sort of reform come into place. So we had very recently in August, we had a business called Metlen, which is a Greek business, which is a metals and energy company. That's what it meant, Metlen, who basically shifted their listing to London. They were already listed on the Athens Stock Exchange, but they thought in order to maximize investor access, in order to get access to passive capital, which is also very important, there's a lot of money just being tracked sort of passively. And given their international profile, that London would be the right place. So they're also increasingly active in the mining space. So they bought a gallium project to ensure sort of a steady supply for their activities. We had, many of you will know, Valterra Platinum just raised a month ago $2.5 billion on the market. So the money is there. The money is there for the right kind of stories and for those companies that go through the effort to build the kind of relationships that they need to build. I think what is important is that we are more confident in terms of communicating to the market. The UK is quite notorious about talking everything down and sort of being very self-critical. If you compare it to the US markets, for instance, you would imagine if you read the news that they can't do anything wrong, but because they're very self-congratulatory. So there is a lesson for us all in Europe to be more confident in terms of how we appear and how we project ourselves, and just to engage with the investor community, because the investor community has experience, but because it is not an easy sort of space with the volatility geopolitically that is going on, etc. You have to be at the front of their faces and tell the story.
Great, thank you. Artem, you are on the other side of the equation. You are building the mines, developing the mines, seeking for the financing quite successfully, as we've seen from your presentation. What would be your advice to those mining and exploration projects right now in Europe, to those who are trying to develop them and are going from financing institution, from different types of financing institution, where to put focus on, how to present the project? Is it ESG credits? Is it sustainability? Is it amazing geology or nice jurisdiction or fantastic tax regime? What would be your recommendation to them, how to obtain financing which is affordable, cannot be too expensive, it is fast, they cannot wait for long, and it's doable. Yeah? So as a conclusion, your good words to all those who are trying to seek this financing and make mining happen.
It's very simple. A good mining company is made of good resource and good people. If you have both, money will come. Money is a commodity. They will chase you as they're chasing us now. If you have good resource and good people.
Yeah, that's fantastic. Thank you so much. I think we're almost out of time, and I will invite you now to the fantastic fire chat discussion, which my good friend Rusland will lead. And gentlemen, thank you, and I hope you'll find the time for our audience in the coffee break to share more of your experiences and give them some good advices. Thank you so much.